This is Brian Putt. I'd like to talk to you about the value of information and having better visuals for discussion with decision makers. Even when the analyst is able to conduct a proper value of information exercise, they oftentimes have difficulty explaining it to the decision makers. The decision makers are not versed, they don't understand the value of information, and they're reluctant to make a decision if they do not understand the analysis. On the other hand, decision makers may want to gather too much information. Perhaps they're doing this because they're really procrastinating. They really don't want to make a decision. Or perhaps the decision maker is on the other end of the scale and does not want to gather enough information. Perhaps they just want to move forward with their gut decision. So how can we present the value of information to better explain to the decision makers and so they can improve their decision quality? Let's use a case study to understand the graphical way to present the value of information. Let's look at the Blackgold case study. Blackgold Petroleum is buying petroleum products under a long-term market-related price contract and then sells those products to a customer at guaranteed prices. However, recently, the purchase price of the product to them has increased, resulting in a loss to Blackgold when selling to the customers. They have a contract that has a provision whereby they can reduce the supply of product to the customer by 10% due to circumstances beyond their control. And this would save Blackgold $480,000. So what is the frame for Blackgold? If Blackgold were able to sell the product purchased at the current market price during the lawsuit, they could realize $420,000. Further, they would not incur the loss selling to their customer. However, there's a 40% chance the Blackgold customer could sue. And there are three possible outcomes. There'd be normal damages of $1.4 million, 60% chance, double damages of $2.4 million at a 20% chance, and only a 20% chance they could win the lawsuit. Furthermore, if Blackgold lost, they would likely have to pay additional court costs of $100,000. So the focus decisions of this case study is, should Blackgold withhold 10% of the petroleum supply from the customer? What is the value of researching similar cases in the past and obtaining information about the judgments? Let's call this perfect information. And the cost is $2,000. So with perfect information, we would know whether it would be win, normal, or double damages. And the third focus decision is understanding the value of researching the customer's past actions and current attitudes towards legal actions at a cost of $10,000. So what is the likelihood that the customer is actually going to sue? So without going through all the economic evaluation, let's just look at the results. The incremental value of not invoking is $800,000. And there's a 70% chance that we're going to be better off. But it also means by invoking that we accept the possibility of double damages of $2.8 million. And that's shown down here. So what is the net value of invoking? Well, that's the difference between these two curves. And in this case, it's pretty simple to calculate. Here is the $800,000 delta shown here. And we're about $1.4 million better off here. And downside is only 1.5 incrementally versus not invoking over here. So how can we look at the possible outcomes of the judgment? That is, would we win, normal damages, or double damages? First of all, we have to ask, what is the reference case? Well, the reference case should be the best alternative with no information. Well, that was invoking. So our best case is invoking the clause, not invoking. The expected value is lower with information on judgment, by $51,000. If I invoke, I have a positive 312, but if I get information about the suit results, it's only 261,000. So that delta is equal to the 51,000 over here. The difference between these two curves can be calculated using the simulation, and we can see that a lot of the times we are invoking. Same case as our reference case. That's why it's a zero delta. Actually, this is a little bit negative by the cost of gathering the information. So almost 80% of the time, it's the same outcome as no information, other than the fact we had to pay for the information. But there's an 8% chance where we decide not to invoke, and we would have had to pay double damages. And that is a benefit to gathering information on the judgment. But there's also like a 12% chance we think it's double damages, but the customer did not actually sue. So that's a loss. One of the advantages of gathering information about the possible lawsuit outcome is that we reduce the downside risk. We don't have this big double damages because we knew it was going to happen. Information only has value if our decision change. So gathering information should never have a negative value of information other than possibly the cost of gathering. So why does information on past cases have a negative value? The maximum value with this information is to always invoke. However, always invoking is the reference case, so why would we gather the information? Once again, information only has value if we can change the decision. So not invoking the indicated double damages, which would be the gut feel response, decision policy, reduces the downside, which might have value to a risk-adverse decision maker. So now let's move on to the customer. Does gathering information about the customer, whether the customer is likely to sue, going to add value? It does add value. It adds $35,000. So we're going to compare our reference case, which is invoking the $312,000, with the value with the customer information, which is $347,000, a difference of $35,000. There's no large downside. You can see here we've lost this downside because we know when the customer is going to sue or not. 60% of the time, we have the same outcome as the reference case. That's over here. That's 60%. And that 60% is also represented over here. We have the same outcome when we look at the distribution of the value of information. Then we can talk about these two tails here. This tail here is we do not invoke, and double damages would have been assessed. And over here, we do not invoke, but if we had, we would have won. So what if we had information both on whether the customer is going to sue and the likely judgment? Let's just think about this holistically. If the customer is not going to sue, then obviously I want to invoke the clause because I'm better off. And if he is going to sue, I would only want to invoke if I was going to win the lawsuit. Well, the sum of those two outcomes is actually 70%, close to 70%. And that's what we're seeing over here as being better off, or being equal to invoking. Over here is when we don't invoke and we incur the $480,000. When I take the delta between these two, I get the difference of $138,000. Here, that's 70% chance where we're both invoking, in the reference case and in this case where we have information on both. There's the outcome over here where I'm better off because I didn't invoke and I would have incurred double damages. And there's 20% probability where I do not invoke and I would have incurred normal damages. So here we see the value added is $138,000. 450 less 312. This chart of risk and reward allows us to balance those two factors. Let's define risk as the probability of losing money. Perfect information on the suit has lower EV and higher probability of losing money. Here is the perfect information on the suit. So it has a lower EV than no information and also more risk. Perfect information on the customer has a higher EV but also higher risk. And so whether one would take that option versus the no information is a function of their risk attitude. And finally, if we have information on both, we can achieve a higher expected value with really no change in the risk. So the point of this video is to understand that the value of information is easier to understand with the distribution of a value of information. VOI can be difficult for an analyst and even more difficult for them to explain to the decision maker. Graphics with good explanations of where the value is being realized from the VOI can help tell the story. If you'd like to learn more about the value of information distribution, you can view this video about the process regarding the Abbey Winery. I'm also happy to share Excel models with you or to answer any questions you might have. You can contact me at brian@theputts.com. I'm also available on LinkedIn. Thank you for watching.